What if you invest $100,000 in the best 3 growth ETFs? We know you are currently working towards a dividend income that can cover your retirement essentials, but what about the extras? Your child's college fund, that dream trip around the world, or maybe even leaving behind a legacy. That dividend income won't cut it. Let us show you how to grow your wealth beyond monthly dividends and build a portfolio that transforms $100,000 into millions. Today we're going to reveal the 3 best growth ETFs that can supercharge your portfolio over the next 20 years. But we're not just looking at the big names or flashy returns. We're diving into the strategy behind each ETF, why they're built for growth, and how they stack up against each other. From good to best, we'll guide you through the ranks, and at the end, we'll uncover the ETF that could turn your $100,000 investment into a massive $5.8 million portfolio in 20 years. Ready to see how your money can grow? Let's jump in. FSPGX. Imagine a fund that captures the growth potential of America's corporate giants, companies like Apple, Nvidia, Microsoft, Amazon, and Meta platforms. The Fidelity Large Cap Growth Index Fund, FSPGX for short, does just that, offering investors a chance to ride the wave of large cap growth in the U.S. equity market. Now let's talk about its strategy and holdings. FSPGX aims to mirror the performance of the Russell 1000 Growth Index. This index tracks large cap U.S. companies exhibiting strong growth characteristics. By investing at least 80% of its assets in these securities, the fund provides exposure to industry leaders poised for expansion. FSPGX is a powerhouse of market leaders, with its top 10 holdings accounting for 59.5% of the portfolio. For one, it is heavily skewed toward technology at 41.66%, led by giants like Apple, Nvidia, and Microsoft, which drive innovation and economic growth. The fund also emphasizes consumer cyclical stocks at 17.74%, including major players like Amazon, capturing the potential of discretionary spending. Overall, this concentration reflects the fund's focus on sectors driving innovation and economic growth. This focused allocation makes FSPGX a strategic choice for investors seeking exposure to high-growth industries and dominant market leaders. Since its inception on June 14, 2016, FSPGX has delivered competitive returns with a year-to-date return of 34.5% and a 5-year annualized return of 19.2%. Its low expense ratio of 0.035% enhances net returns, making it an attractive option for cost-conscious investors. The fact that FSPGX emphasizes growth over income is evident from its metrics. Let's break it down. There is also a robust 19.3% annual return on share price, showcasing the fund's strength in delivering capital appreciation. The fund has a low dividend yield of 0.36%, reflecting its strategy of reinvesting profits to fuel business expansion rather than paying out dividends. Additionally, its negative dividend growth of 1.57% per year further highlights that dividends are not a priority. Instead, the focus is on capital appreciation, driven by its holdings in dominant high-growth companies. This makes FSPGX an excellent choice for investors seeking long-term portfolio growth rather than immediate income. If you invest $100,000 today with no further contribution, in 5 years, your portfolio value will grow to $245,000. After 10 years, you can expect around $602,000. In 20 years, your portfolio value will become an outstanding sum of approximately $3.6 million. Now, you would find that the annual dividend is around $11,000, and this is because of its focus on long-term growth through capital appreciation. Overall, FSPGX offers a straightforward, low-cost avenue to invest in large-cap growth stocks, making it suitable for investors seeking long-term capital appreciation. However, its concentration in the technology sector may introduce volatility, so it's essential to consider your risk tolerance and investment goals. Moving on, the next growth ETF you should know is SCHG. The Schwab U.S. Large Cap Growth ETF, SCHG for short, is designed to track the performance of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. Its aim is to replace the returns of large-cap U.S. companies exhibiting strong growth characteristics. For its strategy, SCHG employs a market capitalization-weighted approach to focus on large-cap growth stocks. This strategy emphasizes companies with higher growth potential, often characterized by increasing earnings and revenue. Moving on to its holdings, the fund's portfolio is diversified across various sectors, with a significant allocation to technology. This, of course, reflects the prominence of tech companies in the growth category. As of December 31, 2024, SCHG's top holdings include major technology firms such as Apple, Microsoft, NVIDIA, and Amazon. These companies are leaders in innovation and have demonstrated substantial growth over time. Notably, SCHG shares a lot of similarities with FSPGX, particularly in its top holdings. Both funds include market leaders like Apple, Microsoft, NVIDIA, and Amazon. These are dominant companies driving growth in the technology and consumer sectors. However, SCHG differentiates itself with a higher allocation to communication services and healthcare sectors. This means SCHG provides more exposure to companies like Alphabet or Google's parent company and healthcare giants Eli Lilly. We believe this aligns with its strategy of capturing growth opportunities beyond just technology. This broader sector diversification, combined with SCHG's low expense ratio and strong growth orientation, makes it a compelling choice for investors looking to balance high growth potential with exposure to critical industries like communication and healthcare. SCHG is all about growth, but it offers a little extra on the income side too. Its dividend yield is a modest 0.39%, but unlike some growth-focused funds, it has a positive dividend growth rate of 4.57% per year, meaning those payouts are steadily increasing. This low yield and dividend growth are typical of growth-focused funds like SCHG. It ensures the value of your investment grows over time rather than relying on immediate dividend payouts. It's an excellent choice if you're looking to grow your wealth for the long term rather than seeking regular income. The real highlight, though, is its annual return on share price of 20.2%, showcasing its strong potential for long-term capital appreciation. It's a great option if you're looking to grow your portfolio while still enjoying a small but growing dividend. If you invest $100,000 in SCHG, and it continues to deliver its impressive 20.2% annual return, your portfolio could grow significantly over time. After 5 years, initial investment could be worth $255,000. In 10 years, that could be $650,000. After 20 years, that initial investment could be worth around $4.2 million. Your dividend income will also stand at approximately $14,000 per year. This projection highlights SCHG's strong potential for long-term capital appreciation, while also providing a small but steadily increasing dividend payout. It's a fantastic option for building wealth over the years. In summary, SCHG offers a straightforward and cost-effective way to invest in large-cap U.S. growth companies, with a portfolio that includes some of the most influential and rapidly growing firms in the market. Just like FSPGX, the fund's focus on growth stocks means it may experience higher volatility compared to more diversified or value-oriented funds. Last on the list, VGT. The Vanguard Information Technology ETF, VGT, is designed to track the performance of the MSCI US Investable Market Information Technology 2550 Index. Notably, it provides investors with exposure to a broad range of U.S. information technology companies. Interestingly, VGT employs a passive investment strategy that aims to replicate the performance of its benchmark index. This approach involves investing in a diversified portfolio of information technology stocks, weighted according to their market capitalization. What this means is that it follows a simple strategy where it buys stocks from big tech companies with more money invested in larger companies. The fund's holdings span various subsectors within the technology industry. The goal is to mirror the growth of the technology sector as a whole. Let's take a look at its top holdings. As of December 31, 2024, VGT's top holdings includes Apple, Microsoft, Nvidia, and Broadcom. These companies represent a significant portion of the fund's assets and are leaders in the technology sector. Unlike FSPGX and SCHG, VGT is a bit different in the sense that it focuses almost entirely on technology. We mean 90.58% of its holdings are in tech companies. This makes it much more specialized. While FSPGX and SCHG include a mix of sectors with a lot of tech but also other industries, VGT zooms in on the tech world specifically, investing in software, hardware, and semiconductor companies. It's a more concentrated bet on the tech industry compared to FSPGX and SCHG, which have broader portfolios. So if you're looking to really lean into the technology sector and take advantage of its growth, VGT could be the way to go. VGT has a low dividend yield of 0.58%, which is typical for a fund that focuses more on growth than income. It's not paying out a lot in dividends, but that's because it's all about reinvesting in the growth of big tech companies. The dividend growth is also solid at 12.24% per year. So while the payouts are small, they're steadily increasing, which is also great for long-term growth. The real standout is its annual return on share price, which is 21.9%. This shows strong potential for the value of your investment to grow over time. Now, if you invested $100,000 in VGT and it continued growing at that 21.9% rate annually, your investment could grow to about $276,000 in 5 years. In 10 years, your investment sits pretty at $760,000. And at the end of 20 years, you would definitely be all smiles with an investment portfolio worth $5.8 million. Of course, the annual $28,000 dividend income is also something to look forward to. This makes VGT a great choice if you're looking for long-term growth in the tech sector with the added benefit of steadily increasing dividends. So if you're looking to build wealth for the long term and ride the wave of growth, FSPGX, SCHG, and VGT are 3 standout ETFs you should consider. Each offers a unique approach to investing in high-growth sectors. No matter which one you choose, these ETFs provide the potential for strong returns, and by investing today, you're setting yourself up for a brighter financial future. So why wait? Start investing now and watch your money grow with some of the best growth ETFs out there. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.